How's it going, everyone? Welcome to the Proving Ground Mastermind. We're going to get started here right now. Let me, if you guys get a chance. Yep, once you guys get a chance, go ahead and let me know if you can see my screen, if you can hear me talking. And we'll go ahead and get started. All right. So here are our social links. Go ahead and feel free to pause if you'd like or rewind this later on, but we're going to move on. We got a lot to cover today. So we started a session or a series, right? And it's Become a Seven Figures Day Trader in 4 Simple Steps. Last week we talked about choosing a setup. Okay, and so this week we're going to talk about backtesting the setup. Next week we're going to talk about the execution, and then of course the rinse and repeat process. And each of these have a framework, and we're going to go over these frameworks. Okay, so last week, just to kind of recap, our recommendation was choose one chart, preferably a 60-minute chart, no less than 2 parameters, no more than 6 parameters. Choose one currency pair and consider, what is my risk appetite? How often will the setup occur on this pair? It is important to know your percentage goals, your weekly, your monthly, your 6-month, your 1 year, right? All right, give me 1 second, Jordan. Let me check that really quickly. I may just switch it over. I'm trying a new mic, but let me switch it back. Give me 1 second. Let's go.
All right. Okay. How about that? Jordan, Joshua, is that better? Let me know. I'll wait for that. As I wait, I'm going to just go ahead and push on. So just chat that in. Okay, awesome. Thank you. Thank you for letting me know that, gentlemen. Appreciate it. Okay, so this is going to help you determine how many setups you'll need to reach your goal, right? So we're going to talk about backtesting the setup. And last week we talked about this setup. We just kind of, floated it and, pulled up a random one. And right now, as it stands, our consideration, and this is fluid because we've just established this, but this is fluid because what we had decided was we want to look for major minor just entering the overbought or oversold. We were considering, do we want green on top? Do we want separation? And I think that was one of the parameters, is that we're going to have separation or divergence in pressure. And then in this instance, they are both pointed up. So that is probably something we want to consider, that primarily because we wanted to do something uniform. The other thing is that we considered was pivoting prior to just entering the overbought. And that's one thing that, and looking at it, we may want to be a little fluid with, right? I would recommend taking note of TNT. If you guys are into using TNT, maybe taking note of those. But as it stands, we didn't use TNT for this setup, so we're using pressure major minor. And I think part of that is because for me, major minor and pressure just makes sense. If you guys want to add to this, of course you absolutely can. But for the purpose of what we're doing throughout this series, we're just going to use its simplest, right? So that's going to be major minor and pressure. So again, this is a 60-minute chart, so Euro USD. So we have our currency pair, we have our pattern. It's not set in stone yet. Our pattern is not set in stone yet. So we want to know what is a yes, what is a no, and what is a maybe. And of course, the maybes are no's. And then we want to determine what time of day we're going to be executing this, right? So here are the steps we want to take when we're backtesting the setup, or the things we want to consider prior to backtesting the setup. So for one, what parameters must be present to trigger an entry? So we're going to actually, work on that today. We're going to work on what parameters must be present to trigger an entry, right? And so here's how a lot of this started, guys. When we decided we wanted to backtest, again, kind of going back to the story that we started before, right? No one was teaching backtesting. No one was talking about it. I had never even heard the term, right? And so coming from a market research background where we collected information and we analyzed it to create a predictive model as to how people were going to vote, how people were going to buy things, how the weather was going to be, how traffic patterns were going to be, so on and so forth. Anything that gives a projection, like a business model or anything, has some sort of predictive element to it. And the predictive element is based on the compilation of information that you collect based on historical information, right? You can read a farmer's almanac and you can get some idea, some concept of what's going to happen this crop season, right? But not just 1 year, but multiple years, right? And then you kind of take the sum of that and you figure out what the best outcome is going to be. You don't want to use an average, right? You don't want to use an average, because where does an average put you? It puts you in the middle. So if we're talking about a win percentage and it's an average of all the information that you collect, then you're at a 50 to 55% win percentage, right? Which is, if that's what you want to be at, great, but that's a whole other psychological facet to be able to deal with, having back-to-back-to-back losers. You could have tons of back-to-back losers with a 50% win percentage, right? So there is a whole psychological facet to being able to trade that way. And because you have such a low win percentage, you got to use a low risk percentage. And because you have a low risk percentage, it'll take a really, really long time to get to anything significant. Okay, so those are some things you want to consider. But first, let's talk about this setup thing. We establish what our setup is going to be, partially, right? Because we still need to determine what parameters are going to be present to trigger an entry. So this is going to be fluid for now, right? We're going to continue to work on this. So nobody was talking about any of this stuff. And so, Tim and I got together and we realized, look, we need to find consistency, right? Because the markets change, and I don't know when it's going to change. You don't know when it's going to change. Nobody knew. For those of you guys that remember 2020, March, April 2020, the market for some of you guys just seemed to, you had the rug pulled out from under you. You felt like, this is crazy, right? This is insane. This is not normal, and it is absolutely normal. And now you know that. That will happen again. And we did a session on this, right? There's always some reason for it to happen, whether it's a recession, a depression, whether it's another country going through it, that it's going to happen again. This time it was just called COVID, right? It was called COVID-19. That's what caused it. In 2016, it was President Trump. And, in 2008, 2007 and 2008, it was the recession. In 2015, it was a recession for another country. 2016, it was, Brexit, and it was a ton of things, right? It always has a name. It always happens. You may not have been here long enough to realize that. Right? You may not be trading long enough to realize that. And let me give you guys a clue here. Sometimes people that have been around, maybe not our organization, but have been around day trading long enough, still don't realize that, right? They still don't understand that the market changes. They end up giving up too soon, which is why 90+% of individuals that attempt to day trade fail. So again, we realized this, and now we are informing you of this. And that's why we talk so much about backtesting, because you could have something that works really well right now for this market condition, because this may be all you know, or you came to some epiphany right now in this condition. But as soon as this condition changes, which could be today, it could be tomorrow, it could be, who knows, right? Nobody knows. But when it does, not if, but when it does, is that setup going to hold up the way you've been trading it? Because if it doesn't, then it's back to the drawing board for you. Right? Okay, so this is part of our realization. So we started obviously researching, figuring out why is this occurring, right? Because we were thinking of the market as just this thing that just kind of ebbs and flows, and there's no real intelligence behind it. Right? That it's just going to do a certain thing because somehow in our brains we just think there's just some kind of rule that says when it reaches this level it has to go the other way, or reaches that level it has to go the other way, or when the indicators do X, Y, and Z it has to do this. It has to move this much or whatever it may be. And we realized really quickly that that's not the case. So what is it then? Well, we could go back and we can look at historical information. So we realized, okay, in any other predictive model, we can go back, look at historical information, collect certain data points, and then analyze it and determine what the best outcome could potentially be going forward, right? And we use probability, not possibility, right? We've talked about this. We can't use possibility because if we use possibility in any aspect of our life, we would do nothing. We would do nothing. We would sit at home in fear, and we would die of starvation because we didn't want to choke on a chicken bone or a noodle, or whatever, right? We wouldn't walk out of our door because we wouldn't want for some, airplane to fall out of the sky and smash into us. We wouldn't drive to work because we could get into a car accident that could maim or kill us, right? We wouldn't go to a job because we could get fired. Anything is possible, right? Now change that. Change that way of thinking. If anything is possible, then the only thing that you should embrace is the possibility of your success. If you're going to use that concept, then use it positively in your life and not negatively, right? It is a conscious effort that you have to put in to think in that direction. You have to think positively and take every negative thought captive, because fear isn't real. It's a construct of your imagination. Most things that you fear have yet to happen, right? So if they are possible, right? But they haven't happened yet, and it is also possible that they will not happen. Okay? So let's change the paradigm there. Now, let's look at probable, because that's the only thing that we can use to our advantage is probability, right? Math and science. So let's go to probable. So when we talk about probable, well, we need what's called a representative sample, okay? So what is representative of what we are doing? Well, market conditions. So what market conditions are there? Well, each currency pair has different market conditions at different times of the day. Right? So we pick one currency pair, right? We pick the time of day, we pick the currency pair, and then we backtest it, right? So when we realized this, we realized, okay, each currency pair moves differently at different times of day, right? So we have our setup, and we'll establish what our setup is at some point. And then we know what time of day we're available, what works for us right now with our 9-to-5s and with our family and our fiduciary responsibilities and everything else. We pick a currency pair based on that information, based on our risk appetite, based on our personality. Do we want a fast-moving market, slow-moving market? That's why time of day is before currency pair, right? So we want to know this time of day what currency pair is most conducive to our risk appetite and our personality. Okay, and then once we have the currency pair, then we go to backtesting the proving ground. Now, time of day is going to be relevant because the best time to trade is the time that you're available to trade. We realized that when we looked at, okay, what is the best time to trade? So we asked people, right? We asked coaches, we asked on the On It webinars, things like that. Hey, when's the best time to trade? And everybody had an opinion. Well, the best time to trade is X. And some of them, actually most of them would say, well, when there's volume and liquidity, right? When the market is moving really fast. Okay, but what if that is not conducive to my personality and my risk appetite? Well, then I'm forced to have to adapt to that. And if I have to adapt to that and it doesn't go so well because of psychology of day trading, then I could very well sit in non-adaptation, right, and be losing for a long time until I can hopefully adapt to it. Or I can form fit day trading to me. What time am I available? And what if I'm not available in the mornings? What if I'm at work? Then I end up in a situation where I'm not consistently taking trades at that time. And if I am, then it's half-assed, right? It's not actually focusing and having that uninterrupted trade time. It's more just thrown together because I'm in a rush between getting to work or getting ready or at work or whatever it might be, right? It's not the best time to trade. So what is the best time? The best time is what's best for me. The best time is what's best for you. and we may not have the same quote-unquote best time. So in long story short, nobody can tell you what the best time to trade is. That's for you to determine, right? Okay, and then based on that, obviously, we look at the currency pair. And again, we realized each currency pair moves differently. Which one is most conducive to our risk appetite or personality, and then we pick the currency pair based on the time that we're available to trade and the setup. Okay, so now we've got that, right? Now, why did we go back to 5 years prior? Well, because we realized that in order to encompass all the different market conditions, which the market moves up, it moves down, and it moves sideways. Now, within moving up, it moves short-term up. It moves bias, right, really far up, and just for a long period of time. It moves down the same way, trend, and then just bias, right, where it just shoots down, right, and then sideways, right, short-term consolidation, and then long-term consolidation, right? Okay, so these are all, there aren't any other ways. Does the market move backwards? Does it move, no, it moves up, down, or sideways. That's it. Those are all the ways that it moves. And we just want to see when it moves up, down, and sideways, long-term, short-term. We want to see all those different things, right? And we realized in order to encapsulate that, we would have to go back 5 to 7 years, or we'd have to backtest 5 to 7 years. And there was a time where we could not get 5 to 7 years back to back. In other words, 2015 through 2020, right? That's, or 2019, 15, 16, 17, 18, 19, right? That's 5 years. There was a time where we had to kind of piecemeal it. We had to go back to 2008, and we had to go back to 2011, and we had to go, and then 15 and 16, So we had to kind of piecemeal it. Now, you can see that this is more relevant than you guys may even understand, because later what we would find out was that it takes an average of 5 to 7 years for a day trader to be successful, or to learn how to be successful in the market. Not even be successful, learn how to trade, how to be successful, and then another 2 to 3 years to make that success into profit. Okay? 5 to 7 years. Why? Because they're not back testing, they're front testing, right? They're just starting with a concept and they're trading it, and the market condition changes. They got to go back to the drawing board, and then they make a tweak, and then they go back into the market, and then the market changes, and they go back to the drawing board, and they make a tweak, and then they go back into the market. And if they can hang with it, then 5 to 7 years, they've got it. They figured out all the different market conditions. And then from that point, they can start being successful. Okay? So what was the epiphany for us prior to even knowing that it took traders 5 to 7 years to be successful? Because let's be honest, for some of us, if we'd have known that prior to getting involved in trading, we may not have done it. We may not have done it, because that is the fact. It doesn't mean it's the fact for you. It doesn't mean it's the fact for us as an organization, because we know it's not now. We know that it doesn't take that 5 to 7 years for us. Why? Because we figured out that you could go back, right, and look at 5 to 7 years at all the different market conditions. Now, the key here is that some people don't have the tools that are consistent enough that they could go back and test 5 to 7 years and get a solid answer. You see the power of the indicators. The indicators have been around for 2 decades, right? The algorithm has never changed. As internet speeds become faster, the indicators become faster. Not your internet speed, but just the speed between the algorithm and the connection it receives from the market. Not even your internet connection, but just the connection overall. As bandwidth and speeds increase, then that algorithm becomes sharper, because it's pulling that information every millisecond. So if it gets that information faster, then that every millisecond is going to become more and more and more accurate. Okay? So when we realized this, we realized, okay, we have 5 to 7 years, right? We didn't know that it took 5 to 7 years for traders to be successful. We just realized we had to go back that far in order to get all the different market conditions, right? This wasn't some epiphany that happened overnight. This is over months and months and months that we had to come to this conclusion and understand what is our representative data. We invented the process of the golden ratio analysis, okay? We didn't invent backtesting, but we definitely have an optimal way of backtesting. Right? Okay. So, we didn't invent the wheel, but we don't make it out of wood anymore, right? We use rubber. Okay, so just to kind of give you an analogy there. All right. So, okay, we had one piece of the puzzle. Okay, we wanted to collect all of those different conditions, right? And we wanted it to be at the specific time that we were available to trade. And if you guys watch some of the earlier Mastermind videos or the Proving Ground videos, we weren't even using time of day as a parameter, right? We've evolved, and you guys can watch that, right? So I'm not contradicting. I didn't have that realization yet, right? Why? Because if I tested every single condition or every single time, then I would take the whole of that and figure out what the most optimal is. Then that would be including times that you don't even trade. Why would it even matter how the market moved at those times? Right? So we're not going to test times that we're not available to trade. Why? Because the market moves differently at different times of the day. We only want to look at the time of day that we're available to trade, the best time for us on the currency pair that we've decided, for the setup that we've decided, and then back test it because we want to see all the different market conditions and how that setup occurs at that time on that currency pair. Right? We didn't just pull this out of our rears. It's something that we had to painstakingly figure out, right, through a lot of trial and error. Okay? So we finally had this epiphany, and we decided, okay, let's narrow it down, right, to the specific time of day. And then that meant that we would actually have to decide, based on the time of day, what currency pair we're going to use. And that's how we came to that realization. We had already come to this realization right here that we needed to go 5 to 7 years, or 5 years more specifically, right? So now we had the full picture, and we had the order in which they had to happen, right? Because this is what's most conducive to the individual trader. Okay, so we called that the proving ground, the time in which you go back, right? In this case, backtest from 2016 to 2020. That's the new proving ground. Now realize that there's some issue with that with Green Chart 2, and it is actually getting results. So that's great. Okay, and then once we've done that, we realized, okay, now we have a whole bunch of data, right? And there's specific data points that we wanted to collect. And at first, we decided we wanted to just see what that setup was going to do. So we said, okay, if it draws down 50 pips or more, then stop counting at that point. So it draws down 50 pips. Then stop counting, and whatever up it went in your favor, then that's it. That's your post-trade movement, and that's your drawdown. Just call it 50, and that's probably not going to work out very well. Okay, and then if it goes in your favor, 100 pips or more, then stop counting at 100, and then whatever happened before that is your drawdown, and then just mark it as 100, because that's there's not many people, if any, that can say how they consistently get 100 pips, right? They just say, oh, I trail it, and it, sometimes it happens, sometimes it doesn't. No, I want it down to math and science. What percentage do you know that you can get 100 pips? And no one can. It's like, okay, it's just kind of luck of the draw, right? So we don't want that. We want to be very precise as possible, right? So we capped it at 100. So sometimes the candles would go days before it tapped out, before it hit a 50 pip drawdown or a 100 pip profit. And so the other one was within that time, if it went, let's say, down, let's just say 10 pips, and then went up, let's say 30 pips, and then went back down to like 10, 15 pips negative, then this was your peak, and that was your drawdown, and that was the stopping point. So there was a lot of rules that were, and if you guys have watched any of those earlier golden ratio videos, there were a lot of rules that were put in there, and it was much more difficult to backtest than it is now, believe it or not, right? So now we've sequestered it to 6 candles, right? and sometimes less, just depending on the setup. But let's say as a base, let's say 6 candles. Okay, and so that means that we're going to look at, here is our setup, and here's the time of day that we're trading it. So our setup occurred on the time of day on the currency pair, and let's say we're in January 2016, right, because we're still backtesting it every day from January 2016 to December 2020. And let's look at the next 6 candles, 1, 2, 3, 4, 5, 6. And what is the highest point it went in those 6, or the most it went in our favor in those 6 candles? Okay, so let me show you guys what that would look like. And for whatever reason, my ESET, which is my virus protection, is blocking Secure Online Day Trading University, so it's not giving me correct indication. So I got to figure that out with the programmers. Once I figure that out, by the way, I'll pass that information on to you guys, because you guys might be dealing with the same thing. So it's actually flagging it as a Trojan, so I don't know what's going on there. Okay, so let's say, for example, let's look at a good example here. Let's say that we are taking, let's look at this, and let's say from right here, we're taking 2, 3, 4, 5, 6. Let's say from right here, we're taking a sell, okay? From this candle right here, we're taking a sell. And here's 1, 2, 3, 4, 5, 6, okay? Now, out of these 6 candles, what's the most it went in our favor? Well, right here, 9 pips, okay? So it went 9 pips in our favor, okay? And looking at this, 6 candles, our knee-jerk reaction is to say, well, this is how much it went against us, right? But if we look at this more logically, if we were out of the trade right here, hypothetically, if we were out of the trade right here, right, so the market went here and then here, and we got out of the trade. We're not in the market anymore. So is this drawdown? No, none of that is drawdown. So what is drawdown then? The lowest point, the point it went against us, the most it went against us prior to this point, right? Okay, so what is that then? Right here, it went 4.8 pips. That's the most it went against us before it went in our favor. The most it went against us was 4.8 pips before going about 9 pips in our favor, right? Okay, so our drawdown, okay, is 4.8. And how long did it take to draw down and come back to break even? So we know it's 4.8, so let's see. There's 4.8 right there. And then it came back to break even about right there. Okay? Now, hang out with me because I'm going to show you guys something. Let's just round that up. Let's say that's 1 hour and 5 minutes right there. So that's 65 minutes, okay? So it drew down, so our duration, how long it took to draw down and come back to break even, was 65 minutes, okay? That's our duration, 65 minutes. Now, let's say that it drew down 4.8 pips and it came back to break even right here, right, and then went back up and stayed right here and then came back through. But none of these points got higher than 4.8. Then this point is still considered where it came back to break even. Because after this point, it never went any more against us. Okay? And we just want to see how long it takes to draw down and then start returning back to profitable. So the first point in which it comes back to break even is where we say, okay, right there is our duration. So even if it doesn't continue into profit after that, right, we just want to make sure that after this point, when did it come back to our starting line, if at all, right? And even if it stayed negative, as long as it didn't stay more negative than the highest point, right, then we stop counting at that point. So I want to be clear about that for a moment, okay? Now, that is our duration right there, okay? And then we know that we go about 9 pips in profit, so let's see when that happens. So you see even these came back up, right? And there's 4.8. Let's see. Are we looking at the same time? 4.8. Hold on. That is weird. Okay, hold on. Okay, right there is our starting point. Okay, check. 5.8. Oh, hold on 1 second. There's 4.8, and oh, there it is. That's why. It's because my line is covering it, because it happened on the same candle. Okay, so there's 9. That's what I was missing. Okay, so right there, from where it came back to break even, right here, to there is where it took profit. So if this is a 5-minute candle right here, then let's just split it, right? So then this would be, we can just leave it at 65 minutes. And then our post-trade movement, how much it moved after it came back to break even and went into profit, is 9 pips. And it took about post-trade movement duration about 2 minutes. Let's just say 2 minutes. If we wanted to get it more exact, we could use a 1-minute chart or even replay it. But let's use this. So what does this tell us? If a lot of our trades that we collected looked like this, then we would know, first of all, we draw down about 5 pips. So if we had a stop loss at 5 pips, it's not likely to hit it. So that's a good place. And we have a take profit of, let's say, 9. This is Euro USD, so let's say 8, right? Because we want to account for spread. Okay? And we know that when it draws down, it can draw down for as much as an hour pretty often, right? So we have a couple things we can work with. Can we get a better win percentage if we wait an hour before entering the trade? Or what if it draws down 5 pips, or let's say it draws down 3 pips 90% of the time over the course of 15 minutes, right? That's what we see based on the duration, the drawdown. Over the course of 15 minutes, it draws down about 3 pips. Then we can say, okay, well, we're going to wait 3 pips before we enter, or we're going to wait 15 minutes before we enter, whichever comes first, right? And then we'll enter the trade. And our post-trade movement duration, we could say after about, let's just say, 30 minutes, I'm just making this up, let's just say 30 minutes, the probability of winning that trade decreases by 10%. But after an hour, the probability of that trade winning decreases by 50%. So if we're in that trade for more than an hour, it's 50% less likely to win. That gives us an option to close the trade if we wanted to after an hour or after 30 minutes, wherever it is. A little bit of drawdown, a little bit of profit, whatever it might be, right? So you can see you could build a whole discretionary method out of a systematic backtesting method. So collecting the drawdown, the duration, the post-trade movement duration, this tells us that it goes negative for about 4.8 pips over the course of 65 minutes. And this tells us that it goes profitable for about 9 pips over the course of 2 minutes after drawdown. So we stay in profit for about 2 minutes, and we're negative for about 65 minutes. Now, this is only one example, so that's hardly math and science. But you can see if we had 400 examples of this, 100 examples of this, then we can analyze these numbers and figure out which one happens most often. What happens most often for drawdown and post-trade movement? Most often, 70, 80, 90% of the time, right? What happens most often? And then what we're able to extrapolate out of that is your risk to reward, right? And your risk to reward is your stop loss and take profit. Now, that's not all we need, right? Because we could have a risk to reward, but if it's not within a win percentage that's profitable, then the trade doesn't win. So we need the risk to reward to reflect positive for whatever win percentage we get, right? So that means that if I have let's say I have a 70% trade, okay, wins 70% of the time, okay, we see, okay, this will win 70% of the time if we use a 15 pip stop loss and a 5 pip take profit, right? Or let's say if we use, let's say this is 60% actually. Let's do this for a second because I want to show you something. Let's say this is 60% and we have a 10 pip stop loss and a 5 pip take profit, okay? And we say, okay, I can win more of these trades. I can win 10% more of these trades if I move my stop loss out. How many? Just think in your head, okay? Because I already know that there are people right here on this webinar that have thought this before. My stop loss is too close. I need to move it out because I keep on hitting my stop loss, and that's why I'm losing money. I'm using a 10 pip stop loss and a 5 pip take profit, and I'm still losing money. Why am I not winning? So I need to move it out further. So I'm going to use a 15 pip stop loss and a 5 pip take profit. Now I'm winning 70% of the time. Right? And maybe you don't even know that you're winning 60% of the time or winning 70% of the time. And here's the problem with that. If you're winning 60% of the time with a 2-to-1 risk to reward ratio, that's why you're losing. Not because your stop loss is too close. It's because your stop loss is too far or your take profit is not enough. So you think the answer is giving yourself more room, and all that does is put you in the same situation at a higher win percentage. You're still not making profit, right? Let's do the math. You guys know me. I'm going to show you. I'm not just going to tell you. I'm going to show you. We took 10 trades, right? And the reason why I always say this, I always show you guys this stuff, is because I want you guys to be able to know and look at it this way every single time you look at a risk to reward and risk percentage. I want you guys to commit this to memory, right? This process. Let's just take 10 trades, because the same for 10 is going to happen in 20 and 30 and 50 and 100, right? If it doesn't work in 10, it's not going to work in 1,000, right? If these are your parameters. So you win 6 trades, right? For how many pips? 5 pips. 6 out of 10 you win for 5 pips, which is what? 30. You win 30 pips. And you lose 4 trades. For how much? 10. Which equals what? 40. Negative 10. It's not because your stop loss was too close. It's because your stop loss wasn't close enough. It's because your take profit wasn't more, right? It's one of those. It's not. You got to have a 1.5 to 1, let's just say to be safe, a 1 to 1 risk to reward ratio for a 60% to win. But that means that you have to win at 60% with a 1 to 1. You can't just decide I'm going to have a 5 pip stop loss and a 5 pip take profit because I win 60% of the time with a 10 pip stop loss and a 5 pip take profit. Do you hear that? I win 60% of my trades. Well, if I'm winning 60% of my trades and I need to have a 1 to 1, then that means that I'm going to change it to a 5 pip stop loss and a 5 pip take profit. No. How does that work in your brain? No, that doesn't make any sense. You win 60% of your trades with a 10 pip stop loss and a 5 pip take profit, which does not work. That means you have to figure out something that does work. Can you win 60% of your trades with a 5 pip stop loss and a 5 pip take profit? You have to find that out. You don't just decide. I mean, you can go ahead, but it's not going to work. It's not likely to work, right? Probability-wise, it's not likely to work. And even if it does, it doesn't mean that's the best way to trade that. There could be an even better way than that, right? Okay. So if we say, okay, then we're going to trade it. We're going to move our stop loss out, okay, by 5 pips because we want to win more, right? Okay, great. You're winning more of your trades. Awesome, right? Okay, so you took 10 trades and 7 of them won this time for 5 pips, which is 35. And only 3 of them lost for 15 pips, which is 45. You're in the same boat, right? You're in the same boat. You're not getting anywhere. Here's the problem is that it takes you a really long time sometimes to get to the place where you realize this is still not working, right? And you're shooting in the dark. You want to be able to win and know exactly why you won, and then you're an expert. And you want to be a master? You want to be a master of day trading? Then you do that consistently for years, and you will master day trading. But at least in the meantime, you're an expert and you're building and you're replacing, supplementing income, you're building wealth, you're doing all those things. You don't have to be a master at day trading to be able to build wealth at day trading. You just have to do the simple stuff. And if you're not doing it and you know you should be doing it, well, that's just your own laziness, and you deserve to lose. You deserve to not make what it is that you need to make. You deserve everything that you get. I'm not saying that out of spite. That's literally, right, the way it goes. Name another time, another place, another instance where that is not the case. Right? The only other situations are when there is grace and mercy that is bestowed upon you, that you do not deserve something, yet you still get something. Right? In any other situations where grace and mercy are not applied, you get exactly what you deserve. If you don't do it the correct way, then you fail. That's it. If you want to take a shortcut, try it out, reinvent the wheel, fine. By all means, let me know in 5 to 7 years how it's going. I'm just using the statistics, right? I'm just using the numbers. If you're going to be an anomaly and beat the odds, great. That's awesome. And if you figure out a better way, I want to know it because I'm sure it'll be easier and simpler for people, and that's great. Now, could I give you these numbers? Matter of fact, yes, and I'm actually working on a way to deliver backtest information to you more effectively and more automated, knowing full well that I am depriving you. I will, in fact, be depriving the masses of actually learning how to master day trading because I'm going to give you the easy pill at some point, and I'm working on it. Actually, I was really close, but then we're switching to Green Chart 2, so we're going to, we'll get it figured out a different way, and we will. We'll get it, and it's now that we kind of know some things, we'll be able to get there much sooner. But understand that is depriving you of something, because although we've done all the hard work in figuring it out and doing it multiple times and seeing that it works, and having other students do it and figure out and see that it works, and having time tested and approved, ways of doing this, and knowing all of the things that we learned in that process, in that painstaking process, things that you cannot teach, but you have to experience in order to know and learn and understand and utilize. You, if you had the easy pill, would take it. Great. That's awesome. If it's going to give you financial freedom, if it's going to do all these things for you, great, take it. But I'll tell you right now, I gave you guys backtest data on a couple of pairs, and greed kicked in, and you guys took a whole bunch of them. We're going to talk about that during execution, why that didn't work. It's very simple, and it's just math, and you guys are going to realize really quickly, and you're going to, palm in your forehead and say, duh, of course that didn't work. Or it could have if I'd given it enough time and I had enough in my account, which means I would have had to use much less, lots. Listen, you guys are trying so fervently to find the shortcut that it's a no cut. You're never getting there. You're getting lost in the woods because you think it's a shortcut and you start to take it because it sounds good and you're like water and you pick the path of least resistance, right? But if you would have just backed up, right, just think about this. If you'd have just backed up and did it right the first time, where would you be now? Where would you be today? Ask yourself that question. And then decide if the shortcut really was a shortcut or was it just a diversion and a distraction. And now you realize that it wasn't a shortcut, and now you're just barely starting to hopefully do it the correct way. Because there are still some of you here that are convinced that you don't have to backtest, that you don't have to. And there's others that are convinced that if you backtest once, you're going to be a millionaire overnight, right? So what is the process? They're simple. They're not easy, but they're simple, right? That's right. Best time to plant a tree. Thank you, Jordan. 20 years ago. Next best time? Today, right? Right now, today. That's the next best time. They're simple. These steps are simple. No one said it was going to be easy. They're simple, right? What are we doing? We're going to choose a setup. We did that. What are we going to do with that setup? We're going to backtest it. What parameters must be present to trigger that entry? What time of day are you available to trade? What currency pair are you going to be trading that's conducive to your risk appetite, your personality? Go back. This is the part that you guys hate, right? But what you learn in that process is invaluable because as you watch the mastermind, as you watch advanced indicator training, as you start to pick up things on pressure and on major minor and on TNTs and you say, whoa, I'm noticing something. I'm going to go watch some videos on pressure. I'm going to go watch some videos on major minor. I'm going to go watch some videos on TNT. Whoa, there is that I noticed, right? There's a full, broader picture. Did you have to go and put in all these painstaking hours to figure it out? No, we did the hard work for you. You're welcome. Don't look a gift horse in the mouth, but you do. Because as much as we made it much more simpler for you, you still want it more simpler than that. Right? Because it's just how we are. We're just humans. Right? Okay. So we've back-tested now, and we have all of our data. Right? So let's go over what those data points are, and let's look at it. Look at how we would collect this information. Okay? So again, let's say here we are. Let's say this is not our setup, but let's just look and say this is our setup, okay? This is the Euro USD. This is the time that we're backtesting. It's not, but just as an example. And for the time we're backtesting, our setup, whatever it may have been, occurred, okay? So right there we mark it. We mark that setup, and then we go 6 candles from that point. That, let's erase that. Okay, so here's our setup. And from this point, we want to go 6 candles ahead. 1, 2, 3, 4, 5, 6. There we go. There's 6 candles. Now, let's say we were selling. Okay, that's the first thing we want to establish. How much did it move in our favor? If it's a pip, if it's a micro pip, whatever, mark it. And make sure that when you're marking these, you mark the micro pips, not just the whole pip value, right? So from right there to right there, we move 9 pips. So if that's our peak profit, right? I'm going to show you guys. You guys have everything you need. What did I tell you? You have everything you need to be successful. You already have it. Because you're here, you're a mastermind member. And as a mastermind member, you have every resource. I dare you to ask a question. I dare you to ask a question, okay, right now. And this is not like, oh, I'm going to call you out and say, ha, I told you so. Please ask the question. What do you need? I don't have this in order to do what you're requiring right now, Hiram. I don't have that to do in what you're requiring. Ask those questions in the chat. Ask those questions on Slack. Ask those questions because maybe you just don't know where to find it. That's okay. Give us an opportunity to tell you where to find it, right? How do I collect this information? How do I know what information to collect? I'm telling you right now, and guess what's going to happen in this video? It's going to be put into archives. It's going to be showcased for a week under all lessons, and right here, just like where last week's is, right? Right here. This is last week's, part 1, right here, under all lessons. Top of the page, latest webinar. Boom, right there. You can watch that video. That was last week's. This week's will be here today for another week. After that, it will already be and be recycled into archives. If this is 172, Mastermind 172, then you know in here under archives, you're going to look for 173, right? So you're going to go to the mastermind ones, right? Let's just say best practice. I think these are under best practices. Technique, there's 172. Today, 173 will be here, right? You can go Control, Shift, F, or what is it? Control F, sorry. Just Control F on your computer and type in lesson 172. There you go. Or 173. And there's nothing there yet, right? You can go 170. There you go. Right? And there might be 2 that are 170. One might be the mastermind and the other might be the proving ground. Right? You have everything you need. So I want you to ask those questions. Where can I find this information? Where can I find, the resources that I need to collect the information? Look right here under resources. If you go here to resources, just click on resources. It takes you to this page. Not click on anything down here in the list, but just click on resources. It takes you to this page. And right here, backtest template, golden ratio. Click on that. When you click on it, it's going to download it to your computer. Now you might say, I don't have Excel. Okay, then put it in a Google Doc, right? Google Sheets. Everybody has Google Sheets. If you don't have a Google, then do something else that has something, that's like the Google Sheets or like Excel. If not, then go to Google and start a free web email address through Google, even if it's just for the sake of using Sheets, right? So you click on that, and that will give you the backtest template. It'll download it, open it, and now you've got your golden ratio, right? So what do we talk about? Date. So the date that it happened, the pair, the direction, long or short, buy or sell, the time, right? Let's just say 10, and this is going to be whatever time it is on your green chart 2, because we used to use UTC. Now it's just whatever time it is on green chart 2, because green chart 2 just makes the adjustment for whatever time it is for you. Duration, that's what we talked about, right? What is duration? Duration is the time that it took to draw down, right? Okay, so here we are, okay? So this is 2100, so this is, what is the date? 8/1/2018. So right here, we go date, 8/1/2018. Pair, EURUSD. Obviously, if that's all, you're going to be only testing one pair at a time. I highly recommend this. One pair at a time, not multiple at a time. You're not saving yourself any time. You're just watering down the process. One pair at a time, because the nuances that you notice on that pair are going to be specific to that pair. Don't muddle that. Don't try to memorize or work through multiple things at the same time. It's not going to be more effective for you. Believe me, You're still going to try it because you think you're a multitasker, and you might be, but it's still going to water down the process, and you're not going to utilize the most out of this process. There is a reason why we do this. This gives you experience that would take you 5 to 7 years to get, but you can do it in a matter of hours, 50 hours, 20 hours, 30 hours, right? You get to mastery faster. You're doing it the right way, right? Somebody says if you want to master something, you got to do it 1,000 hours. My argument has always been and still is, yes, you got to do it 1,000 hours the right way. It's going to take you at least 100 hours to figure out the right way. So 1,100 hours, right? You're going to figure out the right way to do it, and then you're going to spend 1,000 hours doing it the right way, and then you're a master. So I'm going to fast forward the process for you because I'm going to show you the right way. That saves you 100 hours right there. Now you just get to practice doing it the right way and start working on your 1,000 hours. All right? So, direction. We'll just say 1 is long, 2 is short. In this case, we know for this example we said 2, right? Duration, right here. Check this out. So let's go 6 candles. This is our starting point, right? 6 candles. 1, 2, 3, 4, 5, 6. Okay. That went 8.9 or 9 pips, whatever it was, 8.9 pips. That is our post-trade movement. So what is our drawdown then? Everything, the furthest it went against us before that point, because that's the lowest it went. That's the most it went in our favor. So what is before that point? What is the most it went against us? That's right here, right? And for how long? Well, we know it was about 65 minutes, 4.8 pips, right? So right here, we put 65 minutes. So we put that in minutes. So it's not 1 hour and 5 minutes, it's 65 minutes. Drawdown, how much? 4.8 pips. All right, post-trade movement, we know that that's 8.9. And for how long? We knew that was about 2 minutes. Boom, next line, right? We go and find our next setup. And let's say our next setup is, I'm just going to make it up here. So we're not looking at our actual setup. And we're running out of time today, so we're not going to actually focus on that today. This is more important, just back testing. Whether we have a setup, but we wanted to establish what our setup was. And we haven't really established that. So, okay, so let's say, I'm just going to look at an example here. Let's say that this, we were looking to sell, right? Right here, we were going to sell for whatever reason. Okay, let's say we're going to sell right there. Okay, so let's go 6 candles from this point. 1, 2, 3, 4, 5, 6. Okay, what is the most it went in our favor? Right there. 2 micro pips. Okay, so check this out. What is the most it went in our favor? Let's look at a 5-minute. 2 micro pips. What happened before that? Nothing. Right? So all it did was went against us for those 6 candles. Right? So we have, hang out with me, you guys. This is going to get confusing. Direction. Let's say short. Time. Let's just say 1 p.m. This is not as relevant to what I'm showing you right now. Or actually, this would be 1300, right? If we were saying 1 p.m. Okay, so duration of drawdown, 0. It did not draw down on us. Drawdown, 0. It did not draw down on us. Post-trade movement, 0.2 micro pips. Post-trade movement duration, let's just say 1 minute. How does that help us? Because we know after it went 2, that was the most it went, was 2 micro pips, and it didn't draw down on us before it went those 2 micro pips over the course of 1 minute. And then after that, all it did was went against us. So what could we do in this situation right here? Because how does that help us? 1, 2, 3, 4, 5, 6. We could say, actually, it did go, but let's say it didn't. I was trying to find an example where it did not go in our favor at all. It actually did after a minute. Let's say it went 38.8 pips over 2 hours. So, or even 1 hour, right? What happened in the first hour? 30 pips. In first hour, moved 30 pips against. There you go. Now you can reference this later, right? And say, okay, well, do I have to go back and see what happened after 6 candles? I mean, did it only move? Did it never draw down? I mean, it didn't stay there, so something happened, right? But what happened was it didn't go in your favor. It just went against you. And after 30 pips, you're just like, you know what? I'm going to move on from that one, right? Unless you find something in here that says, actually, your stop loss could be 40 pips and your take profit could be 15 or 20 or something, right? Then you're like, okay, then I'm going to revisit this one and see, okay, would that have given me what I was looking for? But because you have a note for it, then you know to go back to it if it's relevant. If it's not, good. It took you 2 seconds to make the note on it, and you're never going to revisit it again. But if you need it, it's there, right? Okay, so then you go to the next, right? You collect the next one, and so on and so forth and so on. And you get better and better and better at this. And Jordan, who's actually here, actually got really good at this. And when he submitted, I mean, this is all the information that I ask for when you guys are backtesting. And Jordan was like, I'm just going to collect everything that I need up front, right? Jordan's like, I'm just going to go ham on this, and I'm going to go and collect everything I possibly need or may need, so I don't have to do it over. Look at this. He's got all this stuff, right? And I think I've got other backtest data for you, Jordan, but I always pull this one because this is just impressive. You got times a day that you're trading based on spring and fall. You got your initial movement, your one candle movement, what it did in one candle, and then what it did in the full 6 candles, right? And then tons of notes. Look at this. Look at that, guys. Every single one of those lines has a note. And there are 461 lines. That is thorough. And in that data, he's collecting TNT. If he had how many, against, for, in favor, whatever, the thick orange value, the majors, the minors, right? There's tons of extra information in here that he can use and analyze and collect and get all kinds of new, parameters for a trade. Okay, so this is how we test. This is how we collect it. When it's done, it's all full up, and then we analyze it. We're not going to talk too much about analyzing for this 4-part series. We will follow up the 4-part series and go in depth because I'm realizing that is going to be a necessity. So we are going to go in depth about the setup and how we determine what the parameters for the setup are going to be. But backtest the setup. Notice it didn't take me hours and days and months and weeks and years to show you guys how to collect the information, how to backtest. Just follow those steps that we talked about, right? This part, right? Backtest the setup. Go back, identify where the setup is. How much did it go in your favor? And then out of 6 candles, just use 6 candles. How much did it go in your favor out of 6 candles? Okay, from that point back, what is the furthest it went against you? And then mark that information. How long did it take to do each of those things, right? How long did it take to draw down and come back to break even? How long did it take after break even to go into profit, or your max profit for that one? Collect that information, right? Do it 20 times. Just do it 20 times on anything, right? And even if you're going to break the recommendations that I made, do it. Break the recommendations that I made and look at 20 examples, and you'll find out really quickly why you're not going to want to break these recommendations, right? And I'm sure Jordan is like, amen, and I'm sure any of you other guys that have done a lot of backtesting, you're like, that's right. Don't break that stuff. Not for your first time out, right? You're not going to go and get into an airplane and start doing barrel rolls and loop-de-loops your first time out. Right? You can do it at some point, but let's get some stuff done first, right? What is this? 4 simple steps to becoming a 7-figure day trader. These 4 steps that I will show you today and I've got all the resources, I've got everything that you need in order to be a 7-figure day trader, everything. And I want you to ask me. I want you to ask the group, where do I get this? How do you figure out where you get and what you need? Go at it. Go at it and try it. Do 20 examples. Go to the website, which you have access to. If you are here, you have access to this. You have paid for it. It's bought and paid for. Go to the site today. Today. Have an intention. Make a goal. Go to resources. Download the trading checklist. Backtest template, golden ratio. Download it. Figure out, do I have Excel or do I need to use a Google sheet, right? If you need to use a Google sheet, then go into Google, right? If you don't have a Google account, then create one. These are all the things you have to do to get ready, but you have the ability to. You know exactly where to get what you need if you don't already have it. Okay, now you've got the sheet. Now you've got the video. Now you have your setup. I don't even care if you've narrowed down the time that you're going to look at the setup. I don't care if the 20 examples that you get are for the correct time, right? Or even on the correct currency pair. I just want you to take a step in the right direction and get the information that you need and test 20 examples of a setup, one setup. I don't care if it happens on multiple currency pairs, because I want you to be able to see something. I want you to be able to see what you need next. And what you will need next, and if I were to make a recommendation, I would make a recommendation that you test just to get 20 examples for just the times that you're available to trade on, just the currency pair that you chose to test first, right? But even the setup, right? I would recommend that you follow the recommendations. But if you're like me, and you want to question everything, and you want to go and let's see if what Hiram says is actually true. I think I think I can do it. Believe me, I do the same thing. Believe me, I'm hard-headed like that. But I want you to see it. I want you to go and I want you to do it. And you're going to see really quickly, right? Jordan was already like, amen indeed, right? I want you guys to see. This is, it's simple, but you can make it very, very complicated. I made it very, very complicated when I did it. And I was the one coming up with this stuff, guys. But I made it complicated, and I had to simplify and simplify and simplify. Right? Sometimes the more information we have, the more complicated we make things. We think we need to master all the indicators in order to be successful. We think we need to know everything about everything in order to have some success. And I can tell you right now that I can teach a fifth grader something, and all a fifth grader knows at that point, because they've been going to school and they know when I go to school, I got to get the instructions, and I do what the instructions tell me to do, and I have success in that thing. Right? But us, we start getting these harebrained ideas. We start trying to break that mold. We start trying to reinvent the wheel at every frickin' juncture. And we just overcomplicate the process. Just keep it simple. Whatever the recommendations are in this video series, just do those things. Just try it out. Just try it. See how it fits. Just try it out. If later you have a better epiphany, great. Go with it. But for right now, just backtest one thing. And for right now, just get 20 examples. I don't care how you do it. Just get 20 examples, because I want you to be able to see why we have the recommendations we have. You will see really quickly why we make those recommendations. And I want you to report back. I have enough of you on these webinars that watch live and that watch historically that I want you to report back. I want to see how many of you guys actually report back. I want to see how many of you actually do it. Comment on the video after you've done it. Send me an email, chat in Slack, because not many of you are going to do it. And that's why you're going to keep on crying and complain that you're not successful. You're going to want to blame everyone and everything else except for yourself. I'm telling you 4 simple steps to becoming a 7-figure day trader. But you like your misery and you like your comfortability, you like your laziness more than you like 7 figures. That's okay. To each their own. If that's where you're comfortable, great. It baffles me. It's beyond me why you're here, not just at Trader University, but here on this webinar, right? Because we do the hard things, and we get the result. We get the reward. But if you're not willing to do those things, ask yourself, why are you even here? Why are you paying me to talk to you like this? Right? All right. So I want to hear from you guys. That's my challenge. I want to hear from you guys. And we'll see. We'll see how many I hear from between now and next week. Next week we're going to cover execution, which is very, very important. It deals with psychology and the like. It deals with some of the things with regard to backtesting and our setup. That's execution. We're going to talk about that next week. It is of the utmost importance. Believe me, a lot of you guys are struggling with right now is execution. You'd think, well, it's simple, right? Just push the button. No, there's more to it. And it's becoming more and more evident. So you definitely don't want to miss that. Even if you don't get it live, watch the replay. By the way, I'll see like, a handful of you guys, and then within a day or two, that number's like doubled and even tripled. So that's great. I'm glad that you guys come back and watch this video on replay and watch it time and time again. That's incredible. I encourage you guys to continue to do that. And if you guys have questions, ask them. I don't have Hiram or Group or Slack, whatever. I don't have this thing, right? I don't know where to remind me where to get the backtest template. Remind me how to collect this information. Remind me where I get X, Y, Z, whatever it might be. Where do I see this video? Whatever it is. I want to make sure you guys have everything you absolutely need in order to walk out the steps that I'm going to paint for you. I need you guys to understand this is not something we just pulled out of our tails. We worked our tails off to give you this for you. Otherwise, we would have just done it for ourselves and see ya. Right? Okay, so I hope to hear from you guys. That's my hope. But statistically, maybe I'll hear from 2 of you. Maybe. So we'll see how it goes. Appreciate you guys being here. You guys have a great day, and we'll look forward to talking with you guys next week.